Hi, everyone. Welcome to Navigating Finances During a Career Change. I'm going to take a quick second just to go over our schedule. We're almost at the end, but I want to do a quick check-in. And does everyone see the Career Lab repo? Too many screens, yes?
Yep.
Okay, perfect. Thank you. So almost done. We're all the way down here at the bottom. You should be completely done with all your LinkedIn stuff. If you're not, you can still ask questions and stuff, but that was officially last week. And then we transitioned to interview stuff this week. So you may have even actually met with one of your mentors for your mock interview. But if you haven't done the tech mock interview yet, make sure that you've got your take-home assignment done, because you want to send them that repo link before you meet, not just an hour before you meet, so that hopefully if they have the time, they can go over it and prepare for you. If they don't have the time, that'll be another authentic interviewing experience of someone having not looked at your stuff and here they are meeting you for the first time. But you're going to get all that done by Saturday, which is crazy, just a few days away. If you weren't able to make it to the What to Ask Your Interviewers Q&A with us earlier today, I've got that link right on here. So if you go to the repo, there's a link to the video, or just go to Collab Lab's YouTube channel. And then Friday is going to be our last official session. That's going to be mentors interviewing each other. And this is a super fun and super informative session. It was one of my favorites to watch a tech interview and somebody else, not just me and my nerves experiencing it, but getting to see it from the other side. So hopefully you have time to join us on Friday. And then the last one is Sunday, and that's your graduation. Unfortunately, I won't be able to be there, but I hope that you all can make it to that one. There won't be a formal ceremony. It's a little bit more of a debrief, but it'll be a great opportunity to thank your collabbies, to thank your mentors, and to give feedback, and both positive and negative. The Collab Lab is changing every cohort to get better and better and better. So your feedback is welcome, even if it's negative, like this didn't work for me. That's super valuable. So please come and celebrate and share, and just bathe in the success of you finishing this awesome program. Okay, without further ado, we're going to switch to our topic. I'd like to introduce Lucas Casarez. He's a financial planner who is going to tell you everything you need to know on how to navigate this big life-changing experience that's about to happen to you all. So without further ado, Lucas, take it away.
All right, thanks for the introduction, Shelly. This is going to be either my third or fourth time presenting this, and so each time I've taken feedback that I've received and kind of added and subtracted different things. So thanks for joining me. Let me know throughout the presentation any questions you have. I can do my best to kind of illustrate any example that you might need me to try to run with on the fly. I'll also have a couple of examples that I'll just kind of show you how different decisions might impact different types of people, depending on where they are at their career, where they're at with their finances as they're navigating these finances during their career change. So obviously, huge, big event with finishing the Collab Lab, and then starting your career if you haven't yet already here in the near future. It's going to be pretty dramatic for a lot of people. There will be a significant change in income, and that's welcomed, I'm sure. But then there's also just going to be those new challenges and fun, hopefully fulfilling career that you're just kicking off and getting started. I am a certified financial planner. I'm the founder of Level Up Financial Planning, and I'll show you finally updated a pictures. We haven't had good professional pictures during COVID until just like last month. I think they're still getting cropped off a little bit. Oh, everyone's still sitting there except for my wife's eye a little bit. But that's my family. We have 4 kids. Up until a few months ago, we had 4 kids 4 and under, but now our oldest is 5. We have 1 dog as well. I also have another business that I just do during tax season called Power Up Tax Planning, and that's a fun way for me to just kind of filled some of the gaps that my clients had, where I was doing all their financial planning and they kept asking me, hey, can you do my taxes too? Because I have no clue what's going on. I told them no for multiple years. And you see 3 years later, I was like, all right, I'll just do this, because some of the advanced strategies or even just some basic stuff was falling through the cracks on my client's end or their tax person's end. And so now we make sure nothing falls through the gaps. I also have podcasts that I need to dive back into. I do videos, strategy guides, and cheat sheets. So if you have a question and I'm not able to answer it quickly and easily here, there's a possibility I might have a resource already created. If not, I will find a good kind of direction to point you so that you guys can get the information you need outside of just this very compressed, detailed, quick planning for yourself here. So we'll be diving into how to be financially successful and what does that mean. One of the feedbacks that I've received from previous situations is, hey, can you give us a few more like actual example scenarios of what would happen? And then there's a lot of common questions I get. So kind of like my frequently asked questions, it's gonna be this or that when kind of comparing two different alternative plans or options that you either have faced or maybe facing here in the near future. Transitioning into tech, becoming an engineer, those things very much fun and awesome. Lots of cool opportunities, a lot of fun stuff to work on, but there's some downsides too. So I'll just kind of highlight those. And then also remind you of some of the good positive things that you can expect being in tech. And then hopefully with time remains Q&A. If we're tight on time, shoot them to me in Slack or wherever, and I will again point you in the right direction for those things. So we can dive right in after these disclosures. So as a financial planner and not just like a financial coach that's not regulated, heavily regulated, there's lots of compliance. And so this is just saying, hey, this information is not specific advice to you. It's going to be general education. So good starting points, good, just kind of get the wheels turning and start to explore and find out what things are applicable to you, what things are you interested in finding more about, and kind of digging deeper into those things. If getting in tech and with this transition, I'm sure you've all gotten good at Google. Google will get you a lot of the information you need. The application sometimes is where what gets a little bit tricky, and that's why I still have a job to help people understand, well, based on this definition or what this means, well, what does that actually mean to you, your money, your goals? One thing I want to just kind of highlight is people think that just money in general, whether it's tech or any other position where you can demand a big salary, big pay, is that, oh, if I get more money, I'll instantly be happier. It helps, money helps to a degree, but there's definitely other stuff that you have to have going on. It has to be a positive culture. I've had clients and good friends that have straight burnt themselves out, thought they were quitting tech forever, took a long time off, and then realized that, hey, maybe it was just where I was at. They jumped back in and they're super happy now, being paid twice as much as before they left and kind of took that break for themselves. So it wasn't necessarily the money that changed their happiness, though. It was just being in the right spot, being kind of treated right and respected, and all of those things, and then taking care of themselves too, outside of just working themselves to the bone. So there's been a lot of studies, and this number has gone up, which is why you're not going to see numbers here. It's probably about like 85,000 or so is where it starts to peak on here and starts to plateau. Still increases slightly with each dollar earned. It just doesn't increase as much as some of those earlier dollars from 40,000 to 50,000 or 50 to 60,000. Yeah, once you're in the 100,000, the next $100, you're only going to see $60 of it anyways because of taxes. So that's probably one of the reasons too why the happiness starts to get flatlined there. But there's got to be other things outside of work, things that you enjoy, and that's outside of money, because money is just a thing. It doesn't actually do anything for you. It's how you can kind of harness this and turn it into living a fun, enjoyable life throughout. You don't want to wait all the way till retirement to have fun. You probably want to enjoy life prior to that too. So good combination, balancing out all of those things. And if one thing I'll say that I see is sometimes I'm on Twitter a lot, so I see a lot of people get like stressed out or down if they're not making 100,000 right out of the gate, or maybe they're a handful of years into their tech career and they're still not making $100,000. Well, that's not a huge deal. You don't actually have to make six figures in order to be successful. I have clients making well over that, probably 150, 200,000, and they're actually a financial mess. Even though we're trying to work on things, get them back on track. And it's because that once you get above that amount, if you have spending problems, if you don't have that discipline that's required to make sure that you're doing the right things, it doesn't matter if you have 50,000 or 150,000. If you mismanage your money and kind of constantly don't know what's going on with your finances, good chances are that you won't be financially successful even once you're over those six figures. And yeah, see it time and again. There was actually a news article that said about, I think it was about, it's either 25% or a third. I probably should have looked at this, but it just came to mind as I was talking through this. Either 25% or a third of people making $250,000 or more live paycheck to paycheck. So that's kind of mind blowing, and that's well above six figures. That's huge incomes and still living paycheck to paycheck. And so it just shows you that people that aren't going to manage their money well, you can give them $1 million. Lottery winners lose their money pretty quickly and end up worse off just a handful of years later. So establishing good habits, being disciplined are going to be more critical. And I've even seen people make big progress where they pay off all their debt, they start saving, they start doing all these right things, and then all of a sudden something happens, and then they kind of go on a spending binge, or I just went on a $10,000 trip, but now there's this other thing I want to do and I want to take time off. I'm not going to work for a while. Like, it's really easy to set yourself back as well if you're not being disciplined and following good habits. And so it only takes one or two big mistakes to kind of undo a lot of good things. So you have to have strong habits, good habits, and be disciplined and not blow your financial situation up once you have found some success. And finances, it's just like anything, just your health, your work-life balance, whatever it is that is important to you, the different things that you've achieved, finishing high school, finishing college, finishing a boot camp, finishing the Collab lab this weekend. Like, these things are achievements. They weren't easy. If they were easy, everyone would do them, and they wouldn't be rewarding as they are. And financial success is just like that. It might be something that's not your strength necessarily, but just like anything, if you focus time and intention on it, it could start to become a strength. I've seen people really turn stuff around and go from totally clueless on financial stuff to being able to help their parents, help their friends, and really change not only their financial situation, but those around them that are willing to find out how people got back on track and are so confident about their finances. I can take a quick stop here just to see if Daniel or EJ or Shelly, if anyone has any questions at this point. Nope, perfect. And again, there will be definitely time that we'll try to make at the end for Q&A. Delete on me. I think it's skipping ahead. Hold on one second. All right, so if you were going to make a quick plan, and again, you can Google, you can do a lot of this stuff yourself. Not trying to put myself out of a job. I know it's a lot harder than that. It's a lot harder than this quick plan. But if you're like, hey, I have some time before my next gig actually starts, before my next thing actually starts, I want to try to see if I can do this stuff on my own. Here's kind of the 5 steps that I think would help anyone just kind of get started, get pointed in the right direction. And if you think about it, you don't have to be perfect, but if you start making progress today and you make progress the next day, these things compound pretty dramatically, and you'll be so many steps ahead than if you were just like, nope, I'll wait until everything's perfect before I get started, before I start taking my finances seriously. And regardless of when you start with your finances, time is on your side as soon as you decide to make it be on your side. If you do wait, it's going to be a harder climb, a steeper climb for a lot of people. So step 1, like anything that you're going to try to achieve, like you have to believe that you're capable of it. I think with finances, especially from different backgrounds, economic situations, how parents manage money, grandparents, different things kind of influence us. And sometimes we might think that, you know what, we don't deserve to be financially successful for whatever reason. And so that could be a self-sabotaging thing. You really have to believe and know that, like, hey, you deserve this salary that you guys are about to get, or that salary that's kind of already coming to you. And that's somewhat where imposter syndrome comes in too. Just know that, like, hey, you put in the work. If you put in the work to be successful in your career, well, why can't you be successful in your finances as well? So definitely have that confidence and believe in yourself there. Uh, then this is where a lot of people just kind of skip. They're like, oh, I have so much money, I can just spend it on whatever comes my way, whatever comes up. I can just say yes to everything. Money has its limits. Even those people that make 250,000 probably figure that out, or they don't, and they just kind of continue to struggle. But you don't necessarily want to just say yes to everything, because then they're not meaningful, and you'll probably be struggling financially. But if you target the things that are really important to you, like one of my clients I just met with last night, who boot camp grad, just started career at Amazon, making a ridiculous amount of money for first role. But even he is like, hey, we outlined all these different short-term goals. He wants to support different family members, and that's great and all. But when we got to the end of his kind of cash flow, and he's like, well, what about the additional amount that we'd have for investing? I was like, well, we have all these short-term goals coming up. Like, we either won't fund them if they're not important to you, or if they are important, we're going to prioritize them and start putting money towards that before we start maxing out your 401k and things like that. So having those goals identified, clearly laid out, then we'll make sure that you're able to start allocating your resources, allocating some savings toward those, because those are going to be the most important things to you. Then you'll have to assess your resources. Kind of like what I'm doing with my client is, hey, here's your income. These are where all the money's going. And yes, you can do it, but it's probably not going to feel like as much money as you thought, after taxes is about 30 or 40% of your income between the state, Social Security, Medicare, and the federal taxes. So you look at all your resources with your income coming in, that's probably going to be the most significant until you retire. But then there'll be 401ks, pensions might be the case. I know Shelly has a school background, so if you're government, education, hospital, those are really the only companies that have pensions these days. But those are resources that are out there that you have access to. Home equity, if you have old savings bonds from when you were growing up and grandparents were buying you savings bonds, anything that has a value to can be a resource to help go towards those goals, retirement, anything that kind of comes up. And then start to see, well, with these goals, with these resources, and you start to plot these things out, are you on track? Are you actually going to be able to achieve all these? Or do we need to move things around? Do we have to maybe delay some of these goals, reduce some of the goals? Instead of $10,000 a year traveling, maybe we make it $7,000 a year, so that you can still help your little sister when she graduates from school and give her some funds to get her started. So you'll be able to, once you lay these things out, kind of build your own rough roadmap or game plan, you can see whether or not you're on track and where your resources will get you. And if it's not where you want it to, then you have to start allocating things and moving some things around. So you will be on track and be confident about those things. And then, yeah, you start to create those milestones, different things. So maybe you don't have an emergency savings, and sometimes it's recommended, or you might feel comfortable having 6 months of savings. We'll go from 0 to 6 months of savings. Could be a pretty dramatic leap, and it might feel pretty defeating to be like, that's going to take me forever to get there. Well, let's start with 1 month of savings. Let's build it up. Start slowly, start an automatic savings, going into a savings account. Don't touch it unless it's a true emergency. And once you get that up to 1 month, you'll start to feel that momentum, start to feel pretty proud of the work that you've been doing, and continue to build that momentum forward to get 2 months of emergency savings, and so on and so forth. Same things with like retirement accounts. Sometimes people are like, oh, I want to have $1 million. How come it's taken so long? Well, most people don't get to $1 million until they're just about close to retirement. And so just because you have a nice big income right now, you're not going to get there overnight over the next year or two. This all these things compound and take time and takes that discipline that I mentioned previously. So this is the biggest thing I see, just the main difference I see from someone being successful versus someone struggling financially. And this is whether you're making the same income or not. So successful person making 100,000, struggling person making 100,000, same situation, but the one that's struggling is going to be on this right side. And it's because they don't distinguish between their needs and their wants. Like everything is just a need and everything's urgent. And so they never actually get around to the savings part because they'll save whatever's left at the end of the month. That's kind of reverse. We want to have that on top of things. So income's important. You do have to pay taxes. You don't want to forget about that. Then put in savings. Once you have that tech career, most likely you'll have some extra income. Hopefully you don't need every single cent of, we'll just go out on a limb, say like 70 or 75,000 just to live and breathe and live comfortably. Usually there'll be some kind of small amount that you might be able to kind of apply towards savings. And that is super important to put that first, then the things that are needs and necessities, then what's left, that's where the wants go. And then it really helps you be distinguished between, well, what's important and what would be a nice to have things. Then it makes it a lot easier too when stuff comes up like a bonus or stock becomes more valuable than you were expecting. Well, then that's something that you can apply towards the wants. You'll probably want to put a portion of that towards savings, but yeah, you can figure out your own plan and how much you should save of those kind of windfalls and things that are unexpected there. But yeah, biggest difference is just prioritizing savings and understanding the difference between a need and a want. So for a lot of you, one of the reasons why you made this change is like, I want to make more income. Like, yes, I probably want to feel more fulfilled, feel less robotic about job situation or whatever it is that kind of made you want to take the leap. And so for a lot of you, it is because it was a struggle with previous incomes and resources that you had. And this definitely will change that for you. So you can either catch up. So if you're behind on retirement, this is a nice paying job, hopefully in a career that you're going to enjoy for a long time, will be able to allow you to start catching up on retirement, start catching up on goals and travel. So I know that's a lot of my clients that have been like boot camp grad clients is like, I can actually travel, like we can actually go like other than just visit parents or whatever. And like, yeah, like as long as you don't get too crazy elsewhere, like there's no reason why you shouldn't be able to travel and do some pretty fun stuff. So yeah, catch up on some of those things that maybe you haven't been able to experience or do. And I think another big thing too, that is just a huge surprise of how great it does feel to have that emergency savings. Once you do start to have it, it feels weird because you weren't used to having it before, but just seeing it there just feels nice. And so yeah, you have more money, but there's a lot of different ways that you can kind of start to apply it. So savings, retirement, protection, that's where like life insurance comes in, disability insurance, making sure that, well, now that you generated this new career for yourself that could pay you multiple dollars here, not only today, but multiple years into the future, you're able to protect yourself with life insurance if you were to pass away, disability insurance if you are unable to function and do your job the way that you need to. And then unfortunately, you also pay more in taxes, which is a good thing. The only reason why you pay more in taxes is because your income's higher and you'll never want to trade that off anyways, because even if out of $100, 40% of it's taxed, well, you're still up $60 compared to if you didn't have it. So sometimes people get so focused on taxes, like, oh no, I don't want to participate in the employee stock purchase plan and get another $3,000 a year because I'll just have to pay taxes on it. Well, you still end up with another $1,800 or so of that $3,000. So it's not a good reason not to take advantage of some benefits that you might be eligible for now that you're in tech. So we'll run through a couple examples. So all of them's going to be like the same type of person, just to kind of simplify it. But this, I think I was using age 30 person. And salary now is $75,000, which is $15,000 after taxes. So after the 35% that the federal government's going to take from you and the state's going to take from you, this is still 15,000 more than their current change, which amounts to $1,250 more a month than what they had earned previously. So pretty life changing. And I was talking with Shelly a little bit before you, Daniel and EJ jumped in to this. It's like it's pretty dramatic that, yeah, that's gonna be a starting salary, but it won't take long. Typically, as long as you don't like end up hating your position and leaving the industry, where that will start to creep up pretty, and actually you shouldn't even say creep up, it'll start to boost up pretty quickly after that. So this is a good starting point to already be up $1,250 a month for this individual we're talking about. High debt, so they have $10,000 in credit card debt. Their minimum payment's $100, and that's what they were doing until they made the career change. And they're paying 22% interest, so it ends up being pretty ridiculous amounts of money. They're paying, if they just maintain that minimum payment and they keep using the card and it stays about the same, they're going to pay $2,200 basically just for 1 year. So if they maintain this for 2 years, well, it's going to be $4,200 that they're paying just to borrow this money. So it's pretty large sums of money that we're talking about. And so that's really high debt and high interest for the credit card. We also have a $25,000 auto loan with the $350 payment. Interest rate's only 4% though, so it's not too crazy. Their new position is going to give them a 401k with a 3% match, and they don't currently have an emergency fund. So I'll just kind of walk you through just financially where it would probably be best to apply it, and they don't have to do it exactly to a T, but this will definitely help them out. So again, remember, they have $1,250 after taxes more than what they had previously before they made their career transition. And 3% of their $75,000 salary will be $188 a month. And the reason why they want to do that first, that's why I prioritize this first, is because they actually get $188 from their employer for free. So that's 100% return basically on them putting in the $188. So it's important to prioritize that. I've found a lot of people be like, nope, I want to pay off my credit cards first, so I'm not going to participate in the 401k. And sometimes the match is even higher than 3%. Like, no, let's turn that on. We'll make headway on the credit card. And that is the second priority in this example. So the remaining $1,062, they're going to apply that towards the credit card on top of the $100 minimum that they were making. And in their case, because credit cards don't tend to go up high in balances on accident, it's just easier to stop using the card, and it'll also kind of positively reinforce. It'll look like you're paying it off faster, because you probably will pay it off faster if you're not using it and paying it down more aggressively. And they'll actually pay it off in about 9.5 months or so. And so that's 9.5 months. Their life's going to feel dramatically different. It's going to feel pretty crazy having that monkey off their back of that credit card debt, something that may have lingered for multiple years or slowly grew for multiple years. And in 9.5 months, they're just going to smack that, knock it out. They don't have to worry too much about their current auto loan. Like, their salary is enough that it's not going to impact their life. It's not going to impact their life too negatively. Interest rate isn't too expensive. So I generally don't recommend people pay those things off faster unless they happen to have like bad credit when they applied, and their auto loan rate's like 12%, 10%. Once it's higher, then we'll either look to refinance it, or we will prioritize paying that off next. But after the credit card's paid off, that frees up the minimum payment plus the $1,062 that they were applying, that they can start building up that emergency savings. So it won't take long to then have an emergency savings that's going to start to maintain multiple months if something weird were to happen. I know recession concerns are very prominent right now with inflation and interest rates increasing, and all the goofy stuff that's happening in tech right now with companies rescinding offers, hiring freezes. There's still, at least in my sphere of people and network, I still see more congrats for new jobs hiring than the hey, just got laid off type posts. So I think still things are still positive direction, just not as fast and on fire like it was leading up to the end of the year last year. there's various ways. That's one of the things I love about money and financial planning is like, yeah, there's like ways we can definitely simplify this and make it super simple, but that's not life. There's other things. There's a trip that normally you would have to say no to or you wouldn't be able to do. But now you have an extra $1,250 a month. So you can be more advanced and you don't have to necessarily pay off your credit card in a breakneck speed. Maybe you pay it off in 1 year, and that allows you to do one additional trip or do something like that. So if you're confident and you know that you'll be disciplined and kind of still stick to a game plan, you can say, hey, a chunk of this, instead of paying off the credit card instantly or as fast as possible, can start to go towards a travel savings or for an upcoming event or an upcoming concert, whatever it is that's important that you kind of want to reward yourself for your successful career transition. You can definitely do it. This is, again, just an example that was kind of requested, like, well, what would it look like as an example? And there's the pure money, not taking emotion into it. And then there's the real life, that advanced planning where it's like, hey, let's split this out a little bit more so you're making progress on multiple things. But yeah, that's up for you to decide how you want to decide where to place your funds, the savings, the spending, all the fun stuff. It's always your plan. Even for my clients, it's, hey, I'm showing you what's possible. I'm showing you possibilities, but I'm never going to say this has to be the way because finances is just too fun to do it that way for one. And then there's a lot more complexity there. So for example 2 and the next example 3 that I might have kept example 2 because I just created it quickly this week. But the difference is this one is same individual, just hypothetically they have no debt now. Maybe someone gifted them, they just paid off the credit card, paid off the auto loan, so they have no debt. They're going to retire at normal retirement age, age 65. Same income, same after tax kind of increase, same 401k. And so difference here is, well, now they can actually apply more of it towards retirement if they want to, or they can just increase their lifestyle. So here they're just going to apply the minimum 3%, and they're just going to retire on time. They're not going to do anything too crazy. They're not going to apply all of that savings into the 401k. They're just going to do a 3% match, and the additional 1,000, whatever it was, is something they're going to use for their lifestyle, short-term goals, travel, all those fun things. And in their situation, they'll still be able to retire at 65. For the alternate one, and yep, I did forget to change the example. This is example 3 technically. So same scenario, but this, now they want to retire early. So what if they just applied all that new income? Maybe they were comfortable with their lifestyle, and yes, they wanted to make money, but it wasn't because they wanted to spend it or do something. Maybe they just want to retire super sooner. So in this example, instead of the 3%, they're going to jump it up to 20%. They're going to apply that full 1,250 towards their 401k. They'll still get the $188 match from their employer every month, and their lifestyle is not going to change from their previous career. Their income did, and their contribution rate did. This means they're going to retire 7.5 years earlier. So instead of 65, it'll be like 57.5 years old. So definitely early retirement by most standards. Most people are going to struggle to retire at age 65. But for those that do save and do some of the right things, a lot of them are on track. 62, 65 is the typical range. Most people will retire somewhat comfortably, and anything before that is really impressive because it means that people were saving a higher percentage than what would be normal. So next section is this or that. Wanted to kind of open it up really quick to questions about the examples, or if there's any specific situation that you want me to kind of run through for you, each of you. Don't see nothing in the chat.
I actually was going to ask you about the 401k, but then you had it with, if you want to retire earlier, just up that percentage. So I was wondering if there was like a strategy between just doing what the match is or going way above that.
Yep. So but the example from example 1, they kind of are in a tricky situation because they have the high debt. So in that situation, yeah, just do the minimum 401k, but then then and focus on paying off the credit card. After that, they can start to apply more towards the 401k. In a situation where maybe you don't have high interest debt kind of keeping you up at night, then it really is a lifestyle choice. If you're on track anyways, well, do you want to speed that track up? Do you want to travel more? That's one of the tricky things to do an example, because I just know it's not always clean cut. I have clients that travel is always some form or fashion, and then there's always some other stuff that kind of like pops out like, hey, we want to do this thing. I know it wasn't a part of the plan. I'm like, well, yeah, let's take a look at it. Let's see like what it changes. Like, oh, we can do that. And it just means you work 1 year longer. Everyone's happy with that. Then yeah, why not do that thing? Do whatever that is. And so I think once you know you're on track, that's a good place to be. And then you're able to kind of compare and contrast. Well, if we do this one thing or do this different, well, how does that change things? And then it helps people make those decisions for themselves instead of shooting from the hip or just crossing their fingers and hoping for the best. Like, is this the right thing? So yeah, if you like, Excel can do a lot of this crazy mathematical numbers. I have software I pay good money for to crunch those numbers quickly for me. But yeah, it's really just making those informed decisions and comparing and contrasting so that well, if you do that, that means this. And if you're cool with it, then yeah, go any way you want. Perfect. So this or that segment, I think I actually still even have like the 401k versus credit card or something like that. But this first one is term life insurance versus whole life insurance. Life insurance in general is most important when you have people relying on you. So I have people that have kids. Yep, obviously there's kids relying on parents for income. I have people that have siblings that rely on assistance and help from you possibly. We have parents that may be relying on income, you as a resource in their retirement. And so whenever there's anyone dependent on your income that will still need help and assistance after you pass away, unfortunately, that's where life insurance comes into play. Whole life insurance, pretty expensive. The typical, just kind of the easier one to kind of point to and say, yep, good to get a whole life insurance in this situation. It's actually pretty rare. It's when you have someone that has like a disability, not able to take care of themselves, and maybe you're providing that income for their care, or you're providing that care yourself. So child with disability, parents with disability, brother, sister with disability, anyone that you're supporting, either your time or your money, well, if they might need that for the rest of their life. And so if that's the case, you need something that's going to be in place for a very long time. Term life insurance is going to be very cheap, very cost effective. And that means that for a very small amount, you can get a huge amount of benefits. So you can get a $1 million policy, and it'd probably be like $30 versus getting a $1 million whole life policy. That'd probably be like $350. It's pretty dramatic, the cost. If you talk to an insurance agent, they're going to try to sell you whole life insurance because that's where they get paid. They don't get paid too much on term life insurance at all. And another good reason for term life insurance is when you're in tech, that means you have income that you most likely will be able to invest in 401k, other investments, stock, and probably have a house that's going to be paid off at some point. That means your net worth and your assets are going to be going up. So 15 years from now, you're going to have a whole pile of assets and resources that you don't need life insurance anymore. So if that term life insurance expires in 15 years, well, you're probably going to have a net worth of pretty close to what that life insurance is anyways. And so that's kind of the reason for that as well. Whole life insurance, you're just going to pay that the rest of your life until you decide to cancel it. And it's going to be a high cost expense. So most of the time, term life makes sense. But if you have a unique situation, whole life could have a role there as well. It's just a lot rarer from what I've seen, pushed too. So yeah, debt. Yeah, this is kind of that example: debt repayment versus 401k contribution. So like in the example, make sure you get the match. Super important, even if it's a 6% match. Well, let's get that 6% match because that's guaranteed money, 100% return. Debt repayment would be anything additional after the match. Obviously, you still want to make sure you pay the minimum payment, so you don't want your credit score to go through the gutter. But usually, the reason why credit cards are so horrible in my opinion is because they make the minimum payment so bad that like you'll never pay it off if you only make the minimum payment. So minimum payments usually pretty low to keep your credit in good standing. I should be able to do that and still do a 401k contribution. As long as, yeah, you're not coming in as like an intern or something like that in your new role. Your income should be high enough to allow you to make a 401k contribution and get that full match there. But yeah, after that debt repayment, up until a point, I think that makes a ton of sense. High interest like credit cards makes a ton. Paying off your mortgage faster than you need to, I'm not a big proponent of it. There's a few reasons why that are a little bit more complex. I saw Shelly kind of raise her eyebrow or something. I created a podcast for it. I can shoot you the link to it, the 5 reasons not to pay off your mortgage faster. The easy one to explain is the interest rates is super low, so it's not a huge one. Then the more complex one is, well, with inflation increasing, 10 years from now, your mortgage payment is going to look like a sweet deal compared to what people are paying in rent. And it's just going to be locked in. So it ends up being a really good inflation hedge, is kind of the short story of that complex version of that. Perfect. Should you rent or should you buy? Again, I'm very strong buy. There are some situations though where renting makes sense. So I have clients that are like, I'm still super young. I don't know where I want to live like forever, or I want to be able to be flexible with my career, because although I wish everything was remote, not all jobs are remote just yet. So being flexible for your career, being flexible for significant others, being flexible for yourself to find the right spot that you kind of feel like, yep, this is my tribe. These are kind of my people in my area I feel comfortable and safe in. That's when rent makes sense. If you rent in the same area for multiple years, most likely you just lost a lot of potential of building wealth from buying a home, building up equity, paying down mortgage. So purchasing makes a ton of sense, even with high prices. I know that's one of the pain points right now, and it's been a story. I think I started my business 2017. One of the kind of proponents, because I predominantly serve like younger generation, like people trying to figure out their finances and take those steps and navigate these complex decisions, is like here where I am in Fort Collins, Colorado, like the average home price is like 550,000. Well, that's hard for younger people starting out if they don't have parents gifting them money and things like that. I wanted to help people navigate these and understand, well, a lot of times you might be able to afford it and it might make sense. And you have to get over some of the fear and some of these obstacles that either from media or from parents or grandparents that are setting up roadblocks for you. And sometimes it's just, yeah, just random stuff that you see media wise, news wise, that's like, oh, that I see that everything's going to blow up and the prices are going to fall. Prices very rarely fall. It's happened like twice in the last 100 years where it fell significantly. So it's just, I would not count it on there to be a housing bubble. And that's when you decide to purchase. Most likely you'll lose out playing that waiting game there. So time versus money. This is a little bit trickier, kind of like egg and chicken type situation where like time in my opinion, especially as I've gotten older, time is way more valuable than money. I'll outsource as many things as I can. Having 4 kids, me and my wife both work full time, like around each other's schedules. Like time is very precious, and so we have to maximize those things. We don't hesitate to order our groceries. I have someone pick up our dog stuff in the backyard. I enjoy the break of mowing the lawn, but if things get too busy, we will pay a neighborhood teenager to come and do that. And so like time's important, but early in your career, it's a little bit trickier because the money, although there's more of it, there's probably other things that you kind of have to balance it to. So this one very much is a balancing act. You gotta understand how important your time is to you, how much extra money you truly have. You might not have as much as you think, or you might have more. One of my clients is going through a divorce. She's going to have to sell the house that they've been in, and she's going to get a bunch of cash from that situation. And she's never worked a lawnmower. She's never done like general like house maintenance to get their house ready for sale. And I said, you know what? Like I know financially things feel crazy with everything that you're going through, invest the $30, 40, whatever the going rate is in her area to pay someone to mow her lawn and do those miscellaneous things, because her time and energy and just strain and all those different things that she's struggling with right now, like sometimes it's very obvious and sometimes it's hard because you don't want to spend more money. You don't want to spend money on stuff that isn't fun, like a new tech toy, new gadget, or vacation. But sometimes that will allow you more time to just relax, just kind of take care of yourself, not stretch yourself too thin, and just make those things balance out. And obviously the higher income grows, the more that you'll have the opportunity to do those things. Some people go overboard, definitely, and they spend more money on time saving things, even though they don't have the money to do it. So just be aware of your financial situation. If it looks like you can afford it, then definitely consider it. And if not, then definitely a personal choice at that point. So here's a few of the things to be aware of as you're starting off into this new tech career. So lifestyle creep, I see it happen a ton. A lot of my clients are really good about it because we preemptively talk about these things. But sometimes it's like, hey, I got a raise or I got a bonus like 2 months ago, right after we talked last, and now I'm doing these things. Well, if you got a $20,000 bonus, don't go on a $20,000 trip, because taxes, again, is going to eat up about 30% of that. You don't really have $20,000. So that's one of the things. But also you start to establish these new habits. So habits is a big thing. And if you're used to spending an extra $15,000 every single year, it just puts that much pressure when you retire, because it's not just while you're at work, and that's the lifestyle you're going to want to live when you retire. Your wants and needs, if you're healthy, you're going to want to do all the same stuff. And so $15,000 more a year for the next 50 years is basically what you've done to your financial situation, which means, well, you need to save a whole heck of a lot more money or delay retirement a lot more. If you're not doing, well, let's do 5,000 into savings, 10,000 on trip. That's more reasonable than just kind of doing the full thing. And so that's something you'll want to be cognizant of as your salary jumps to 65,000, 75,000, 100,000, 150,000, 200,000. If your lifestyle increases that full amount and the savings doesn't keep pace, you're actually behind where you were at 75,000. And so that's a lot of things that people aren't aware of that put a lot of strain on yourself, keeping spending with that lifestyle creep there. Layoffs, unfortunately, that's a common thing right now. And it's a common thing in tech. There's cycles where there's crazy massive hiring, crazy amounts of money being thrown off. And then it's like, hey, we outgrew what reality is. And now we need to start laying people off. We need to prune 25, 50%, 10%, whatever it is, job cuts that happen. That's where the emergency savings comes in handy, especially as you're getting started. Emergency savings is more important now than it will be 10 years in the future, because 10 years in the future, you'll have a 401k, you'll have other assets, you'll have stock and things. So it's like, I don't have an emergency savings, but I have all these other resources I can at least tap into before I have to start going into credit card debt and things like that. So not having emergency savings early in your career will be the hardest thing to kind of do, but once you do it, it'll protect you for the first handful of years. 5-10 years down the road, you're going to have a lot of resources to kind of bridge the gap of any type of layoff that would occur. If you go to a startup, sometimes there's lack of benefits there, so you might not have health insurance, you might not have a 401k with matching, you might not have stock options. There's a lot of things that you'll have to decide, well, is it worth working at here compared to going to a more established company, one that's less of a startup? And I can't answer that question for you. I one of my clients asked me, I was like, hey, what should I do? These people are throwing money at me. And it's like, well, if you have to balance more personal things than just the financial side of things. And you do have to realize that you probably won't have a lot of these benefits. Your salary might be higher, but some of that might be eaten into pretty quickly if you have to pay $1,500 a month for health benefits. So positive things, high income and quickly growing income. At some point, you'll kind of hit a ceiling there. But there's other ways to kind of maneuver between management and different roles and things like that. But between where you start and kind of mid-career and high career, there's room, a lot of room for that income to jump up. Employer stock could be pretty game changing, life changing. And more than anything, I think going from just making like 40 or $50,000 a year to making 75,000, making six figures, is you just have a lot more control. You have more control over your time, which is important to me and important to a lot of people. Important of just, you have more control over being able to do things like, hey, I want to see the world, or I want to see my parents more that live wherever, or want to see friends and family more. Well, you have the funds to do it. And a lot of companies are remote, or will allow you to go remote for a little bit. Maybe you can work travel, like go travel, be with them in the evening, but work during the day in a quiet room or a shared office space. So there's just a lot more flexibility and control that you have now, that you'll be making more income and have a little bit more job freedoms, depending on your culture and work environment for sure. Can do questions and answers. I know we're kind of right here at the end, but if there's any quick ones, I can hit those really quick. Nope, perfect.
You are super thorough, so you hit all of them probably.
Yep, perfect. And EJ, I might be connected with you. I'm good friends with Leo Yaki. But if I'm not connected with you, I'm on Twitter, I'm on LinkedIn, I have a YouTube channel. Yeah, it's important, and this is important for you all, anyone listening to recording and just kind of thinking about your careers, is your network is going to be super important. Might not be what gets you your job, but it might help you through a tough time, or just kind of relate to different people. And you might help other people, and sometimes that's more rewarding than them helping you, is you kind of lending that hand and lifting them up, and then you see them blossom and kind of be successful in the future. So yeah, networking is fun, and if we're not connected, definitely reach out to me. I see something in the chat, might just be a thank you. Let's see.
Message from EJ.
Oh, yep. Yeah, I know. I've just, from conversations with Leo in the past, I know he'd be like, oh yeah, and EJ, and I was like, I know EJ from Twitter, I think, but never had a chance of being kind of your presence virtually yet. Perfect. Well, I appreciate the Collab Lab, amazing work that you guys do. So yeah, I'll keep coming back as long as you guys keep inviting me to do these quarterly.
Oh, we will. Lucas, this was so valuable, so informative, so balanced with, and I just love the real life examples and how you spread it out if you're coming in with high debt or no debt. Just a ton of things to think about. So thank you so much. I know that the people that are going to watch the video are going to gain a lot too. And I know we'll want you back, because it's always the highlight of Career Lab. Thank you. I'm just wondering if anyone's got any last minute questions. No, if we're good. No. What were you going to say, Lucas?
Oh, nothing. Just thanks again for having me, and yeah, for anyone watching, and Daniel who's still here. Yeah, just use this as a starting point. Lots of wide things that I cast here with information and topics, and yeah, I think the biggest thing is you guys are in control, and you guys get to really pick and choose how you want to define your life, more so now moving forward than maybe previously in the past, with less fulfilling careers, less pain careers. So yeah, a lot more control. So I'm excited for all of your futures.
Thank you so much.
Take care, Shelly.
You too. Have a great evening, everyone.
See you, Daniel.